Hello and welcome to this podcast. Students often seem to struggle with how VAT affects income tax, and specifically when to adjust income tax numbers for VAT and when not to adjust them. So I thought we'd have a look at this a little further in this podcast. Let's start with a simple transaction. VAT vendor A purchases trading stock from another VAT vendor B, for 114 Rand including VAT. Let's start with the accounting journal entries. Vendor A has incurred expenditure of 114 Rand, so that's a credit to their bank account. At the same time, they can recover 14 Rand in input VAT from SARS, so that is a debit to their VAT control account or to their input VAT account. And the balancing figure of 100 Rand is a debit to their trading stock account. On the other side of the transaction, vendor B has received 114 Rand, so that's a debit to their bank account. Of that, they owe 14 Rand to SARS, so that's a credit to their VAT control account, and the balancing figure of 100 Rand is their sales or their revenue. And because that's only the revenue side of the transaction, vendor B must also transfer the cost price of the trading stock out of trading stock and into cost of sales. How does this work for income tax? Well, vendor A is going to claim a Section 11A deduction for their cost, and that is going to be 100 Rand. Why 100 Rand and not 114 Rand? Well, because Section 11A will exclude any amount incurred where that amount can be recovered from some other person. And in this case, vendor A is entitled to recover 14 Rand from SARS, so that is excluded from their deduction. And on the other side of the transaction, vendor B has gross income of 100 Rand. Why not 114 Rand? Because the 14 Rand has been collected for the benefit of SARS, and gross income includes only those amounts received for the taxpayer's own benefit. And in this transaction, only 100 Rand was received for the taxpayer's own benefit. The other 14 Rand was collected for the benefit of SARS. So that's the accounting and the income tax for a simple transaction using the actual cost. What happens though when the transaction is deemed to be concluded at market value rather than at cost? Some examples of where that might happen: Section 84K, when an allowance asset is disposed of to a connected person, the seller is deemed to have sold it for market value. Paragraph 38 of the 8th schedule says that when an asset is disposed of to a connected person, the seller is also deemed to have proceeds equal to market value. And on the expenditure side, Section 12C says that an allowance will be calculated on the lower of cost and market value. So that's just a few examples of where transactions are deemed to be at market value rather than at cost. Well, market value is just the arm's length price at which a willing buyer and a willing seller, who are not connected persons, will conclude a transaction. Market value includes VAT. It's just the price on the sticker in the market. And we can't exclude any portion of that market value on the basis of received for own benefit or incurred but entitled to recover, because the market value is this hypothetical number. It's not the amount actually received, and it's not the amount actually incurred. So we can't exclude amounts of VAT on the basis of those principles. So let's have a look at an example transaction with income deemed to be market value. In this example, vendor A sells an allowance asset to its holding company, vendor H, for 57 Rand. The market value of the asset at the time was 200 Rand, while the tax value was 120 Rand. Well, for income tax purposes, vendor A has to calculate a Section 84 recoupment. That recoupment will be calculated with proceeds equal to market value. And there's no adjustment to that market value. It just is the full market value. Minus the tax value of 120 Rand equals a recoupment of 80 Rand. There is no adjustment for any VAT in that transaction. There are also potentially capital gains tax consequences for this disposal, but I haven't included them in this example. On the VAT side, the VAT that vendor A has incurred is based on the 57 Rand. Times 100 over 114 equals 7 Rand in output VAT. There are no special VAT rules that apply to this transaction. Both vendor A and vendor H are VAT vendors, and so section 10.4 doesn't apply to them in this transaction. Now let's have a look at a transaction that is deemed to be at market value on the expenditure side. In this example, vendor B buys a new machine from its subsidiary company for 570 Rand and brings it into use in a process of manufacture. The subsidiary company would normally sell a similar item to a third party for 285 Rand. So they've sold it to vendor B for more than market value. Let's do the VAT first. The VAT on this transaction for vendor B is 70 Rand. It's calculated on the 570 Rand actual cost incurred by vendor B. Section 10.4 again doesn't apply to this transaction because both parties are vendors. On the income tax side, vendor B is going to claim a section 12C allowance, but that allowance is going to be based on the lower of cost and market value. And in this case, the market value is 285 Rand and the cost is 570 Rand. So the market value is lower than the cost. Don't forget that you must compare like with like. So market value includes VAT, so you must compare it to a VAT inclusive cost. So for vendor B, their section 12C allowance is going to be based on the market value. And the question is that market value going to be adjusted for VAT or not adjusted for VAT? Well, you would think, based on our income example, that it would not be adjusted for VAT. But before we jump in, we need to have a look at section 23C. Section 23C says that where for the purposes of applying any provision of this Act, regard is to be had to the cost to the taxpayer or the market value of any asset acquired by him or the amount of any expenditure incurred by him, and the taxpayer is a vendor as defined in Section 1 of the Value Added Tax Act, and the taxpayer is or was in any previous year of assessment entitled under Section 16.3 of the last mentioned Act to a deduction of input tax as defined in Section 1 of that Act, the amount of such input tax shall be excluded from the cost or the market value of such asset or the amount of such expenditure. Now, that is a fair mouthful and we haven't even got to the bottom of the provision, but these are the important items. First of all, it applies to any cost to the taxpayer or market value of any asset acquired. And the taxpayer is or was entitled to a deduction of input tax. If those two apply, then what must we do? The amount of such input tax shall be excluded from the cost or the market value of such asset or the amount of such expenditure. Excluded from the cost or the market value. What does that mean for our example transaction? Well, what section 23C means in this instance is that although our market value is 285 Rand, it must be reduced by the actual VAT incurred by vendor B and recovered from SARS. It's the actual VAT recovered, the 70 Rand. It's not the market value times 14 over 114. So the market value here must be reduced by the actual VAT, and the section 12C allowance is calculated on the net amount. In summary, let's have a look at what happens to income and expenditure, either when the tax amount is going to be based on the actual amount received or incurred, or when it's going to be based on the market value. On the income side, if income is based on the actual amount, then the income inclusion is going to be the amount minus VAT. That's on the principle that gross income only includes those amounts that have been received for the taxpayer's own benefit. And when expenditure is based on the actual amount incurred, then the deduction is going to be based on the amount minus VAT. because deductions are only based on amounts incurred that the taxpayer is not able to recover from anyone else. When the amounts are based on market value, income will be equal to market value with no adjustment. However, expenditure will be equal to market value minus the actual VAT. Not market value times 100 over 114, market value minus the actual VAT. And that's because of Section 23C. Section 23C only applies to expenditure. It does not apply to income. I hope that's been helpful, and I hope it's helped to clarify how and when to adjust income tax numbers for VAT. Thanks for watching.